This material is a draft financial dossier analyzing recent corporate strategies in the tech sector, specifically examining how companies like Taboola and Zoom are balancing employee stock ownership plans against share buybacks within the broader context of the Nasdaq index. The current structure leaves the macro-level Nasdaq information fundamentally disconnected from the micro-level company analyses of Taboola and Zoom.
Yeah, I noticed that whiplash right away. You open this document, and the very first thing hitting your eyes is just this raw alphabetical list of NASDAQ 100 companies.
Right, the whole directory.
Exactly. We're talking Adobe, Airbnb, all the way down the page to Zscaler. It takes up a massive amount of real estate. And right next to that huge block of text, there's this quick, almost throwaway press release.
The one about the February 25th, 2026 NASDAQ Investor Day?
Yeah, the Times Square headquarters event. It's just sort of sitting there.
It's a very common trap. It almost feels like a reflex for analysts to front-load all the macro data just to prove they did the groundwork.
Like a checklist.
Exactly, like a checklist. But then you turn the page and we're suddenly neck-deep in Taboola's fourth quarter 2025 revenue.
Which was what, $522.31 million?
Right. So you're looking at a giant index list, an event invitation, and then boom, a granular breakdown of an ad tech company's quarterly net income. There's just no connective tissue explaining how we got from point A to point B.
I get that. I mean, I wonder if the writer just assumed the audience would naturally bridge that gap themselves.
You think they overestimated the reader?
Maybe. If you're reading a high-level dossier, maybe the author thinks you automatically know why the macro environment dictates Taboola's margins.
Sure.
The problem is, even for a highly advanced audience, leaving those pieces in total isolation makes the document feel like three separate memos simply stapled together.
Stapled together is the perfect way to describe it.
You're forcing the reader to do the editorial heavy lifting of figuring out why a Times Square event matters to Zoom's balance sheet.
And when you force the reader to do the heavy lifting, you lose your authority as the author. We need to use the NASDAQ Investor Day event and the NASDAQ 100 index as a strategic framing device.
A macro backdrop.
Exactly. A backdrop that intentionally sets the stage for the specific financial maneuvers of the individual tech companies later in the dossier.
So we need to build a bridge from the macro to the micro, rather than just throwing both on the table.
Right.
There are a dozen ways the author could approach this, but let's look at a couple of concrete routes to actually pull it off. For instance, what if that February 25th Investor Day wasn't treated as a standalone press release?
Oh, I see what you mean. Like it actually served as the narrative hook for the whole piece?
Yeah.
I like where you're going with that. You mean using it to define the overarching state of tech markets in early 2026 before drilling down into the specific stocks?
Right. Imagine opening the piece by describing the mood heading into that Times Square headquarters on February 25th. You frame the event as a pivotal temperature check for the sector.
That creates a natural thematic ramp.
Right into how specific companies like Zoom and Taboola are behaving in that exact highly pressurized environment. It gives the event a reason to exist in the text beyond just being a date on a calendar.
That's a much stronger hook. Another angle, just thinking out loud here, could be to address the index list itself.
Instead of just dropping the A to Z list?
Yeah, rather than a dry directory that readers are just going to skim over anyway, the writer could explicitly call out the heavyweights.
Like Apple and Microsoft?
Right, Apple, Amazon, Microsoft. Acknowledge upfront that while those giants typically dominate the NASDAQ 100 headlines, the true investment narratives right now, the actual actionable alpha, lies in the specific capital allocation strategies of mid-tier tech players.
That's an interesting way to pivot. It smoothly sets up the transition to the case studies.
It does.
You're essentially telling the reader, here's the whole universe of 100 companies, but here is exactly why we are pulling the magnifying glass over these two specific stars.
Which completely eliminates that stapled together feeling.
Because the macro data is now the funnel that drops us directly into the micro analysis.
It's all about architecture. If you just list 100 companies, the reader is looking out the window wondering where the car is going. If you tell them why those 100 companies matter to the two we're about to dissect, they're following your map.
And the structure then flows logically.
Logically, from the global tech environment right down to the specific, granular capital decisions being made in the boardrooms of Zoom and Taboola.
The draft misses a valuable opportunity to synthesize the parallel stock issuance and buyback strategies of Taboola and Zoom into a singular, compelling industry trend.
This part of the text is actually packed with great raw intelligence, but the delivery obscures the real story. You've got Zoom filing this massive $1.31 billion employee stock ownership plan.
A shelf registration covering something like 17.7 million shares.
Right. And sitting right next to that, they have an ongoing $2.7 billion share buyback program.
And then in a completely separate section, the dossier details Taboola doing something very similar, albeit on a different scale.
Yeah, they have a $23.20 million ESOP shelf for 7.3 million shares.
Happening right as they navigate a critical shift from a 2024 net loss to a 2025 net profit.
Which is huge.
It is. The fundamental issue, though, is how siloed this information is. You read about Zoom's dilution and buybacks, and then you read about Taboola's dilution and profitability as if they exist in alternate universes.
They are treated as isolated corporate updates.
Entirely isolated.
I always wonder if focusing so closely on an individual company's balance sheet causes writers to miss the forest for the trees. By keeping Zoom and Taboola in these separate boxes, the text completely overlooks the broader 2026 microeconomic story.
Which is what?
That tech companies are simultaneously trying to manage two fiercely competing interests, avoiding a shareholder revolt over dilution and throwing equity at employees to keep them from walking out the door.
That is the real narrative here. It's the cost of doing business right now. You have to elevate the narrative by creating a thematic angle focused on the tug-of-war between appeasing investors with buybacks and retaining crucial AI talent through equity.
It's a much stickier angle for an advanced reader. Let's think about how to actually write that synthesis into the text.
Well, one path would be a dedicated transitional section that directly compares their motives.
So, putting them head to head?
Yeah. You contrast Taboola's urgent need to incentivize talent for the rollout of their newer Realize product against Zoom's aggressive need to hoard engineers.
Because Zoom is staffing up for their AI companion, right?
AI Companion, Contact Center, and WorkVivo products. By putting them side by side, you show that despite the massive difference in scale, Zoom's billion-dollar shelf versus Taboola's $20 million shelf, the underlying boardroom pressure is identical.
The ad tech company and the enterprise software giant are fighting the exact same war.
Exactly.
Let's push that a bit further. Right now, these ESOPs read purely as financial metrics. They're just line items calculating dilution, which is how accountants look at them. But what if the author reframed them as literal defense mechanisms in the broader 2026 AI build-out?
So instead of just reporting that Zoom has a $1.31 billion shelf, you explain that this isn't just administrative overhead.
No, it's required artillery.
Required artillery, I like that. They need that equity to fend off fierce existential competition from Microsoft Teams and Google Workspace.
Retaining that talent isn't optional. It's a matter of corporate survival.
Which completely changes the tone of the analysis. It reframes the dilution from a passive consequence of hiring into a strategic offensive necessity.
Right. It transforms the whole section from a dry summary of SEC filings into an active, original interpretation of corporate strategy.
And when the reader sees that a large-cap software company and a smaller-cap ad tech firm are pulling the exact same highly specific lever, simultaneously issuing ESOPs while buying back shares, they recognize a sector-wide trend.
Synthesizing these parallel strategies gives the document a much sharper edge. It elevates it into high-level industry intelligence.
It also respects the reader's time. You aren't just telling them what happened, you're telling them what it means, that these things are happening at the same time across different subsectors of tech.
The buybacks are essentially an apology to the investors for the dilution required to keep the engineers.
That's a fascinating dynamic that gets completely lost when the companies are analyzed on separate pages.
The heavy emphasis on raw financial guidance data currently overshadows the actual risk-reward calculation required by an investor.
There is zero doubt the author did their homework here. The text is absolutely loaded with highly precise metrics.
Almost too many.
Right. We get Taboola's 2026 revenue guidance down to the decimal, $1.99 billion to $2.05 billion.
And we get Zoom's fiscal 2027 revenue guidance of $5.065 billion to $5.075 billion.
We also get these long-tail projections. The text notes Taboola is anticipated to hit $37.6 million in earnings by 2028, and it specifically points out that this requires a 6.4% yearly growth rate.
The problem is that bombarding the reader with dense strings of billions and millions ultimately obscures the core takeaway.
The sheer volume of these static numbers is burying the lead.
Do you think there's a risk that an author feels like leaving out the exact decimal points somehow makes the analysis less rigorous?
Oh, absolutely. It's a common fear, the idea that if you don't show all your math, the client won't think you did the work.
That's usually where it stems from. But look, we all know the people reading this dossier already have the raw data. They have Bloomberg terminals. They've read the quarterly filings.
They are reading this piece for the author's interpretation of that data. The reader is getting an exceptional amount of the what, but the so what, the actual impact on long-term returns, gets completely lost in the data dump.
We need to systematically ground the financial data points directly in forward-looking risk assessments and clear valuation takeaways. Every single number included in the text has to fight for its life to be there.
Let's workshop how to shift from raw data to actionable insight here. There are plenty of ways to handle this, but let's just look at two concrete examples. Take Zoom's impressive 88.1% earnings growth over the past year.
Right now, the text just lets that number stand alone as a testament to their recent performance.
But a much stronger approach would be to immediately juxtapose that historical high against the analyst warnings mentioned way later in the text.
The warnings that Zoom's earnings are actually forecast to decline over the next 3 years.
That's where the friction is. By placing the massive historical growth right next to the forecasted decline, you turn a static metric into a dynamic tension point.
You force the investor to confront the volatility of the stock right there, in the moment, rather than letting them assume that 88% growth is a permanent trajectory.
Friction is inherently more interesting than a flat list of achievements. Another area to apply this is Taboola's valuation.
The draft mentions a $4.80 fair value estimate, right?
Yes, a number by itself is inert. Instead of just stating that figure, the author should explicitly frame it as a 45% upside.
And don't stop there. Tie that 45% upside directly back to the strategic risks we were just talking about.
State clearly that this upside is entirely contingent on whether advertiser demand for the open web can actually outpace the dilution caused by their new shelf registration.
Now that valuation number is meaningful in the context of the company's real-world operations. It links the data directly back to the corporate strategy.
You aren't just saying it might hit 4.80. You're saying it will hit 4.80 only if they win this specific battle.
Building on that, think about how formatting can do a lot of the heavy lifting. When the text wades into dense financial mechanics like Taboola's new $270 million credit facility and their shift to profitability, I would highly suggest using a visual aid.
Or a tightly focused bulleted bull versus bear summary.
That makes complex financial restructuring instantly digestible. An investor needs to quickly weigh the risks against the rewards. A bull versus bear structure does exactly that.
For example, the bull bullet point highlights the new credit facility securing their runway,
while the bear bullet point highlights the potential earnings drag if the realized product doesn't scale.
It does the analytical work for the reader without forcing them to wade through thick paragraphs of prose.
The ultimate goal here is clarity of thought, not just comprehensive transcription. The audience needs the author to act as a filter. If Zoom's revenue guidance of $5.065 billion to $5.075 billion doesn't change the fundamental investment thesis compared to just saying a flat $5 billion, then that exact precision is just unnecessary cognitive load.
By framing the data strictly through the lens of risk and reward, you transform the dossier from an informational summary into an essential analytical tool.
It stops being a document you read to catch up on the news and starts being a document you read to make a decision.
To recap our analysis today, we focused on 3 primary areas for refining this financial dossier. First, we addressed the need to integrate the macro, NASDAQ data with the micro company analysis to provide a cohesive structure, rather than leaving the reader to connect the dots.
Second, we explored synthesizing the parallel Taboola and Zoom ESOP and buyback data into a unified, highly original tech industry trend, focusing on the tension between talent retention and shareholder appeasement.
And finally, we discussed the critical importance of translating dense financial guidance into clear, actionable risk-reward takeaways, cutting through the noise of raw numbers.
To quickly summarize the actionable steps you can take in your next draft, remember to use the NASDAQ Investor Day not just as a data point, but as a strategic framing hook to set the scene.
Create a thematic angle by directly comparing Zoom and Taboola's talent retention strategies.
And critically, balance all revenue guidance with its immediate forward-looking investment implications, perhaps utilizing a bull versus bear structure to make the analysis instantly digestible.
We highly encourage you to apply these revisions to your dossier and submit the updated draft back to the critique for another round of feedback.
We always look forward to seeing how Peace evolves. Thank you for sharing your work with us.